First thing to say, just a bit about me, really. As you can see, that's a very old photograph, and yes, that is a perm. And I've been around for a long time. As an interesting point, mortgage advisor with UK Moneyman for the last 10 years, which is true. Literally today, I'm starting a new job within UK Moneyman. So I'm not actually directly advising anymore as from today, but that's all. I'm still with the company, and I'm just doing a different role within the company. But lots of experience, lots of there'll be loads of old stuff that if you've got any questions, I'll probably have been there when the rules were invented in 1875 or whatever. I always like to start with this. Nobody actually wants a mortgage. People think, well, what is a mortgage? Why would I want one? And actually, I think, well, nobody wants one. All the word mortgage, it's just the legal deed that secures a loan to a property, so that if you default on the loan, they can take your property into possession in order to get the proceeds back from the money that they lent you in the first place. I can't remember exactly the literal French. It's something like paying until death or something. Certainly the mort bit is French for death. But yeah, basically it's just a legal document that secures a loan to a property. Why would you want one? Well, you don't really. You actually want to buy a house. And for most of us, we haven't got enough cash to buy a house. So the only way we can do it is raise the funds by borrowing the money, and we secure that against the property with a mortgage. Now, obviously, lenders are going to want to know that you can afford it. They're not just going to give money to anybody and everybody sort of thing. And in terms of what you can do to help, you can start making preparations early. Obviously I don't know the age range of the people that we're talking to, but some of you probably have never even thought of this, whereas others of you might well be already property owners for all I know. So but the approach that we're taking here is more of a standard approach as to what sort of things can you do to help yourselves. And certainly things like, to get yourself into a good a good financial position. Start saving early, for example. We talk about deposit, i.e. most lenders are going to want you to put some of the money in yourself. They want to see some commitment from you. So the earlier you start saving for it, and then whether you use it as a deposit for the mortgage or not, you've still got you've got savings behind you, sort of thing. You can explore things like ISAs, which are government's savings where you get tax benefits, so you're not taxed on the interest like you would be on other types of accounts. So I'm not an investment advisor, but certainly you can help yourselves by sort of looking at these things. Look at what you do with your money. If you've got spare, you can get it either regular savings each month, or if you've got a lump sum, you might sadly have inherited some money from somebody or whatever. Just make sure that you're doing the best with it, and letting it, make sure it keeps up to date with inflation and things like that. And obviously the more you've got, the bigger the deposit you've got, it's going to be a knock-on benefit to you when it comes to borrowing money, because then you're not going to need to borrow as much. The risk to the lender is lower, and therefore you're more likely to be able to actually get the loan. When you're applying for a mortgage loan, lenders are going to look at status, and by status I mean, what do you do for a living? What is your income? How much do you earn? How do you earn it? How regular is that income? That sort of thing. They're going to look at your credit history, and we'll talk about credit in a little bit more detail a bit later on. But obviously the more you can demonstrate that you've been sensible with your credit, that you've used your credit within its acceptable levels, you've not exceeded overdraft limits, you've not gone over your credit card limit, things like that, the more that is going to be beneficial for you if and when it came to be borrowing money. And obviously the third thing that they're looking at is the property. Is it suitable for security for them? If you didn't pay them, would they be able to get their money back if they had to repossess the property? So clearly, if there are issues with the property that they thought might mean that actually we'd be worried that we wouldn't be able to get our money back, then clearly they might not lend on that particular property. Now, your status and your credit history might be fine, and that doesn't mean that you can't get a mortgage on a different property, but just not on that one. So as I say, status, let's look at that in a bit more detail. So it's a bit like, as I say, basically it's how much do you earn, but also how do you earn it? So in the old days when I had my perm, it was very easy. It was just, most people had a permanent contract and that was that. Or they were self-employed and that was that. These days, you've got things like, agency contracts, you've got 0 hours contracts, you've got people who are self-employed working under umbrella companies, they've set up their own limited company, so they're actually a director of a limited company. And there's lots of different ways that people generate income, and the lenders have had to adapt to that and will take account of it. Everybody sort of says, oh, how much can I borrow? Well, to be fair, I could do that calculation 15 times with 15 different lenders. I'd get 15 different answers because they will all work to their own affordability models. We use the term affordability. It probably should be better described as borrowing capacity. But they will all work to different models. Some of them build in things like Office of National Statistics data into their affordability calculators and make certain assumptions. Obviously, things like if you've got children, what do you spend on childcare? Obviously, just feeding, clothing, putting shoes on your kids' feet that grow every 2 months. All of those things will be like built into their affordability calculators. So there's no standard answer. Most of the lenders would typically go to an absolute maximum of sort of 4.5, or some of them are now stretching it to 5 times, and some, depending on your profession, might even go a little bit more than that. But those are maxima. They're not, and it's not a standard. So don't ever think, oh, well, I'll get 4 times my income, or I'll get 4.5, should I say. Because the lenders will do it very much more specifically. And a lot of it will depend on what income they're actually using. So, for example, if you're a director of your own limited company, most of the lenders would look at, a lot of people who have set up a limited company think that lenders would just go by the pay slips that they have. But lenders won't do that, because you're the person, especially if you're 100% shareholder in that company, the only person that's responsible for giving you your pay slips is you. So they're not going to go by your pay slips. They're going to go by what you've submitted to the taxman. So they will take into account things like your tax returns. Whereas obviously if you work for a big company and you're clearly an employee of, Reckitt's or somebody like that, then obviously they will typically go by your pay slips. And usually they will ask for something like 3 months pay slips. They'll all have different rules though. And that's why it's always useful to speak to somebody who knows what they're talking about, i.e. typically a mortgage broker or a mortgage advisor or an advisor with the bank or building society. And they will give you an idea as to what you can do. But that's your status side of things. In terms of credit score, one of the things that we get asked a lot is how does my credit card affect my credit score? I think, again, there are so many myths and half-truths about things like credit scoring that to try and give anybody a definitive answer as to sort of all of these things, it's really difficult because there's no standard answer. I'm going to pick up on the 2 last points first. Why do lenders check it? Well, obviously, you're going to be making a commitment possibly for the next 20, 25, 30 years, 35 years, that you're going to pay them every month the amount that you need to pay. So they need to be pretty sure that you're going to stick to that commitment. And the best way that lenders have decided that they can check that is by looking at your credit history and deciding, yep, you've always paid your bills on time and you've got a good credit score. Can you get a mortgage without a credit score? Yes. Some lenders don't credit score at all, although they typically tend to be more specialist lenders for people who maybe not got the best credit history or just no credit history at all. And obviously, because they would envisage that they'd be taking more risk because they can't assess your history, then obviously they would typically charge you more in terms of interest for that. In terms of your credit card, I think, or indeed any credit, all I would say is use it sensibly and clear it as much as you possibly can, if that makes sense. So, for example, if you're thinking about, right, I want to buy a house, I'm going to need a mortgage. I've heard that I'm going to need a good credit score. I'll just go out and get a credit card. My heart sinks when I hear that because, to be quite honest with you, your credit score will drop because you've only just taken the credit card and you've not been able to prove that you're actually a good payer at that point. So if you do anything immediately before you're going to take take a mortgage loan out, then it's actually a negative, not a positive. That said, if you are planning ahead and 8 to 12 months beforehand you start a credit card, maybe with a small balance, please don't misunderstand what I'm saying here. I'm not encouraging anybody to get debt. But if you use your credit card for, say, your weekly petrol bill or your weekly shop or something that you would normally pay with your debit card, and then immediately clear your credit card over a period of months, then you will see your credit score build. I think, as with a lot of things in life, balance is the key. Don't take more credit than you need, because I did have one customer who said, I thought I needed a good credit score and went out and got 10 credit cards. Well, lenders are looking at that thinking that particular chap had something like access to something like 60 or 70,000 pounds worth of unsecured credit. Even though he wasn't actually using all of it, he still could, perfectly legitimately, because those credit card companies have all given him that limit. So they were very wary of that, because he could run up a lot of debt tomorrow and there'd be nothing they could do about it, and that could impact on his ability to pay the mortgage. So it's about getting the balance between having a sensible amount of credit that is enough to cover what you might need it for, and getting it cleared as quickly and as regularly as possible to build your credit score up. And obviously, sorry, go on.
Sorry, wait, I just have a quick question. I think someone asked it last year, and I thought it was a very kind of valid question and a good point. I think someone asked last year around like having a mobile phone contract and stuff like that, having an impact on your credit score. So I think, sometimes people keep their mobile phone contracts maybe in like a parents, guardians, whoever's name, but actually I imagine it would be encouraged to take that upon yourself, I guess, as a good way of building credit score early on.
Yeah, absolutely. That also little things like, for example, if you live at home with your parents and you might not be very political and you don't give a monkeys who you vote for, register to vote, because that is, if you're not registered to vote, you're not on the voters roll. For a lot of first-time buyers, I'll use Halifax as an example. Halifax, with their first-time buyers, will put a large amount of emphasis on whether you're registered to vote or not. So, as Dylan says, rather than get your mum or your dad to to pay for your mobile phone, get them to give you the money in your bank account rather than putting the contract in their name. If you put it in your name, it'll help you towards your credit score. But whatever you do, and as I say, any little things like that. The credit agencies are good in that they'll always give you tips as to how to improve your score. But the one thing I would say is, don't take it all for granted that is automatic, because the mortgage lenders, if you think about it, there's a big difference between paying £20 a month on your phone contract and borrowing £150,000 from a mortgage lender to buy a house. So the credit scoring systems that Equifax and Experian and TransUnion use, they're all very general, very generic, and the mortgage lenders will have their own scorecard. They still use those same agencies, but they tailor the scorecard to what's important to them. So certainly things like getting on the voters roll and using sensible credit within reasonable limits is always probably the best general way to approach it, I would say. Is that okay?
Yeah, we said I think we got a hand up. I think
Yeah.
I think Emily had hers up first, but I think she's taken it down. But Ollie, you've got your hand up at the moment. You got a question?
Yeah, I was going to ask, is there any checkers that you'd recommend that weren't as general as Experian?
There's a really good. In fact, I've got a link for it at the end. So if you it's on the last. Remember, Elaine, it's on the last slide. But you can go to a company called Check My File. The reason we would normally suggest those is that it gives you a report from the 3 big credit agencies. So you'd be amazed how much difference there might be sometimes between what's showing on Experian, for example, and what's showing on Equifax. As mortgage advisors, we tend to use it in the way of some lenders will only use Equifax, and so if there's something that's showing on Experian but not showing on Equifax, then we'll recommend a lender because we know we're going to have a least resistance with the lenders who are using that particular agency. But Check My File's a good one. You get a free 30-day trial, and then after 30 days, correct. I'd stand to be corrected, but I'm pretty sure it was, last time I looked anyway, it was $14.99 a month if you kept it going after that. But you get a free 30-day trial, and you can download your full report and see it, and then whether you then choose to carry on subscribing after that, it's up to you. But it is quite easy to cancel if you just wanted to do it as a quick thing.
Would you recommend starting that when you're closer to that time, or while you're saving, or?
I think I would. It depends what you want to use it for. As I say, it will give you tips as to how what things you can do. But I suppose I would always just use it as a check shortly before you were you were starting to think seriously about applying for a mortgage, as long as you've made sure that you're on top of things beforehand. If you've got concerns over your credit, if you're already struggling with finances or things like that, then it may well be sensible to do it earlier. But I think as long as you're pretty disciplined, and as long as you probably keep on top of things yourself and make sure that you are making the payments, then yeah, I would do it just beforehand as a bit of a check, really, and see where that takes you, sort of thing. A lot of brokers will ask, if you've got one, they will ask you for it. So it doesn't do any harm to do it just before you starting thinking seriously about it.
Will do.
So, okay.
Thank you. Cheers.
So I think did something come up in the chat there as well? I think.
Yeah.
Can you wipe your credit history and start again? Basically, no. It's the answer to that. Or if there is a way of doing it, I don't know how to do it. But obviously, if you could just wipe it and start again, then it'd be pointless, because how would anybody who had a rubbish credit score would just wipe it and start again? So to my knowledge, no. What will happen is that if you've had credit issues in the past, then that basically the further away you are from that, the more likely you are to be able to get new credit, and certainly a mortgage loan. And a lot of credit things, well, if all credit, your credit report only goes back 6 years. So if after 6 years it'll have dropped off anyway. Now, the only thing I would say on that is that sometimes people might have say started a debt management plan more than 6 years ago, but that is still ongoing, or they might have made an agreement with, say, a debt collection agency more than 6 years ago, but it's still ongoing. So you could still see the direct debit payments to Lowell in your bank account or to Step Change in your bank account. Then lenders will still pick that up because, as we'll see later, they do look at your bank statements.
There's a couple more hands up.
That's okay.
Sure. Emily, go to you next if you've still got a question.
Yeah, sorry, I didn't realise I'd put my hand down. No, I just more wanted to ask. So my credit score is pretty decent. I've paid most of my bills directly myself for quite a while.
Yeah.
Whereas my boyfriend, he earns more than me, but he's got less outgoings and a lower credit score. Does that sort of even out when it comes to kind of the application or not?
Yeah, I mean, they are looking at the whole picture.
If that makes sense.
Yeah, and again, this is why it's it's almost like people get so hung up on credits. You see, obviously, old fogey that I am, I go back well before credit scoring became a thing. And sometimes it does frustrate me the way that some lenders do really put so much emphasis on it.
Mm-hmm.
The main thing for me is, are you keeping up to date with your commitments? And if you are, mortgage lenders are likely to be more forgiving, shall we say, over things like the score. So I'd never get too hung up on the actual score.
Okay.
For me, it's more about the actual conduct of the accounts within that, because as you say, it might be that like you said, your boyfriend earns more money, he's not got as many commitments, so he's not getting as much chance to build up his score, but he's not doing anything wrong.
Mm-hmm.
And lenders would typically be able to see that. Now, don't get me wrong, if you've I say the score's not important. If you've got 200 or less score, then you're probably going to struggle, for example, because you've probably done something pretty terrible.
Mm-hmm.
But if you're in sort of medium range, don't forget, lenders use credit scoring as a tap sometimes.
Mm-hmm.
So I'll give you an example. Let's say you're a mortgage lender and you decide that you're going to launch this new product. It's really competitive. You're going to knock all your competition into a cocked hat, and you're going to get inundated with applications. Because you're offering such a cost-effective product, it's probably got a really low profit margin on it, and therefore you as a lender can't afford to take risks that those deals are going to run into arrears, because that's going to cost you money to administer, and you might even end up having to take some into possession. So you can't afford to take that risk. So on that particular product, you're going to set your credit score bar really high. Okay, I'll tell you what, I'll stop sharing this because we're not. I'm just conscious of sort of talking sort of is a little square in the middle of the thing. But yeah, so they're going to set the credit score bar really high. Now, if that then results that you're not getting the level of mortgage applications that you expected as that lender, you might think, oh, well, we better drop the score a little bit. So they use that as almost like a lever to turn on and turn off the flow of business. And similarly, if you're another lender, for example, and you're looking at, I'll just use Halifax, for example. Halifax have got this mortgage deal. It's fantastic. We can't compete with that. Well, how are we going to get business then? Well, if they've set their credit score bar quite high, we'll set ours lower and we'll take the ones that they don't do. It's still probably pretty good. We're not going to take all the really poor ones, but we don't have to be asking or setting the same level of credit score bar as, for example, the Halifax are doing on this really keenly priced product. So I wouldn't get too uptight about it, Emily. I said just use it sensibly. If you're planning ahead and your boyfriend hasn't got much in the way of credit, it might be worth taking a small credit card and as I say, using it and clearing it. But don't let anybody misunderstand me. Don't build debt up, because obviously I would be the last person to tell anybody to take debt that they don't need. It's more about showing that you can pay it, not building up debt. All right.
Thank you.
Looks like there's somebody else there, is there?
Yeah, I think Kayla's next.
Yeah.
Yeah, just a quick question. Hi, Wayne. I just wanted to ask if paying something like my car insurance would contribute to improving my credit score.
It can do. It depends how you do it. The thing is, there is what they call premium credit. So if you pay your premiums monthly, particularly things where you're insuring for a year, what the insurance company are doing is dividing your annual premium into 12, and what some of them still do is charge you a little bit extra on the monthly premium to cover the cost that you're paying it over 12 months. So if it is on premium credit, then yes, it does appear on your credit score, and so that obviously can help, because again, you're showing that you're paying it. Obviously, if you do it, it's probably cheaper if you pay it annually, but that wouldn't appear because that's just a one-off payment sort of thing. Does that help?
Yeah, it does. Thank you, Wayne.
Okay.
Then we've got Freya, and I think that's last of questions after that. I think. Go on, Freya.
Hi, I was just wondering, you spoke about the gaps, like the scales that different companies use to get a mortgage. Do those change in the market? Do they move around?
Yeah, and obviously they do move around. They move around all the time, but they don't tell us, obviously, because us, sneaky mortgage brokers would always just be playing the system, wouldn't we? So yeah, they do. But for example, like I mentioned there, they might just tweak it a little bit just to sort of either increase or slow down the influx of applications, for example. So yeah, and that again, that's why you can never be prescriptive. As I say, I would never try and sort of say this is a surefire way of passing a credit score, because it might work with one lender and not with another. The best example I can give you for it, how credit scoring can be very confusing is, I've seen people with very high credit scores fail with specific lenders at specific times for the reasons I've said. They're setting the bar so high because of the pricing of the products. But I've also seen, I think the most extreme one I had was somebody who had a £13,000 unsatisfied default got a mortgage. So, it's all about finding the right lender for your particular circumstances, and they are all different. Is that okay?
Rob, thanks, Wayne.
All right, no problem. So let's go back to this and move on a little bit. So in terms of the property, I think there's all sorts of different properties out there, whether it's flats, whether it's terraced houses, whatever it is. All I would say is, if it's not habitable, you're probably not going to get a mortgage on it. I'm distinguishing mortgageable and habitable for the sense that something could be habitable, but they still might not want to do a mortgage on it. What reasons might that be? Well, for example, we're seeing a lot of issues with flats at the moment. I won't bore you with all of this because it could get really sort of technical and you'd lose the will to live. But things like lease terms on flats can be a problem, and even though it's a really nice property, they might not be able to lend on it just because it's got a very short lease, or the maintenance charges and service charges are really expensive. We get a lot where, for example, the property might be very close to, let's say, a commercial property. There might be properties that it's a really nice house, but there's an electricity pylon or a substation at the bottom of your garden, sort of thing. So they can't, they won't lend on it because they're worried about the resale value if they ever had to take that into possession. So all of these things can affect its mortgageability. Now, again, all I would say on that is it's all very relevant to the particular property. So if you just be careful what properties you're looking at and what things there might be. The legal restrictions, obviously, land law in the UK goes back 1,000 years or more. So you do find some quirky little things like chancellery charges and things where the church has got a legal charge that the on 1/8 of your garden or something like that. There's all sorts of stuff like that. But during the process, which again I'll come on to in a second, that you would have a solicitor that would sort of recommend or look at all those side of things, and then would be able to sort of steer you on that as to whether there's a legal issue that you might want to avoid. Just going back to a few of the things, as I say, I would reduce the debt by all means. As I say, always have an emergency fund. Getting a mortgage could be, the monthly payments can be quite expensive, and so what happens if something goes wrong? Have I got an emergency fund? Is that, have I got something to fall back on? You don't want to be using all your money just to pay for a mortgage or just to buy the house. You've got a life, people have got lives to live. So have a think about things beforehand in terms of your own budgeting sort of thing. Obviously, lending is a risk business, and so the less risk the lender's taking, the more likely you would get a decent rate. If you've got more of a deposit yourself to put in, the rates of interest that you will be offered would usually be cheaper because you're more attractive to the lender because they're not taking all the risk. This is a big one that's come in, and again, forgive me because obviously I can't see all of you. So, but especially these days, and I am going to sound like your granddad now, so apologies in advance. But I know a lot of younger people, particularly, there's a lot of online gambling goes on. There's, your Betfreds, there's your Paddy Powers, your spread betting, and all of the rest of it. Without wishing to tell anybody how to live their life, obviously gambling's not illegal, but it's not great to be applying for a mortgage when you've got loads of gambling transactions on your bank account. So from that point of view, all I would sort of say is just be sensible. And if you are going to have the odd flutter, I'd try and keep it off your bank accounts if possible. Sorry, is that Dormer? Is that with a hand up? Is that right?
Yeah, I think that's the company name. I think they're on the company.
Oh, is it? Yeah, right.
Yeah. But have you got a question?
Yeah. Hello. Can you hear me?
Yeah, I can hear you.
Yeah. So I buy and resell clothes on Vinted, but it comes up as like quite a lot of money. And like just talking about gambling kind of like reminded me a bit. Would that look bad on me because I resell it like in a shop, like it's not like back on card?
You're getting into sort of complex territory there a little bit. I wouldn't say it looks bad because obviously if you're doing that as a way of generating additional income and there's an explanation for it, then no, I wouldn't say that was a particular thing that would look bad. Where I would think, and I've got to be careful what I say here, but what they will be looking at is that if you're clearly making an income from that's not being declared for the taxman sort of thing, then they maybe would have concerns over that. Now, I'm that's not a comment on you. I'm just talking generally. Yeah. But basically the way that mortgage lenders work is if it's good enough for the taxman, it's good enough for them. And so they're looking at, if they are looking at things like undisclosed income, or anything that they feel might be worthy of further investigation, if you like, then they will look at that. So obviously, you're not doing anything wrong. It's not illegal. There's nothing like that. And if there's a perfectly good explanation for it, they will accept it. But just be aware that if it is income, they might want to see where that income has gone. And if it's, if it's not declared, then that might lead to them thinking, well, if you're the type of person that doesn't declare an income, are you also going to be the type of the person that pays the mortgage, sort of thing? So I'd just be a little bit careful about that. And that's not commenting on you personally. I just just watch out for it, I think, just generally speaking.
Okay, thank you.
Okay, all right. In terms of the actual process, so again, let's touch on this because why has my screen stopped moving? That's just what I needed. Let me just stop sharing that. I think my screen's gone to sleep. Well, in terms of the mortgage, there we go. In terms of the mortgage that's just jumped too many screens. But let's jump on that. Sorry, bear with me. Me and technology. I'm not the world's greatest. Let me just go back. I think I've lost a screen somewhere. Well, I'll tell you what. Hang on a sec. I'm going all over the place now. Leave it on that. So the mortgage scheme. So basically, can you get a mortgage? What sort of level of mortgage can you get? In terms of the processes, you hang on a second. Sorry, I'm jumping about all over the place here. I'll just stop sharing in a minute. 1 second. Let me just go back. because I don't know what's happened here, but my screen started jumping about all over. I've got a mouse that obviously wants to work on its own. Sorry, 1 second. Just hum amongst yourselves a minute while I just get this sorted. What were you saying?
Yeah, no rush, Wayne. Just while we're doing that, there'll be a survey that I'll put in the chat panel afterwards. So if you all won't mind just taking, it is literally about 5 or 6 questions, I think. So it'll take 2 minutes. So I'll put it in the chat panel after we finish. But if you won't mind doing it, it just allows us to make sure all these enrichment stuff that we're offering are of interest and are of need. So it allows us to plan future ones, make sure they're relevant. And also one of the questions at the end is actually kind of permission whether you want to share your details with Wayne. So I know a few of you have actually asked some personal questions already, but if some of you sat there thinking actually you've got some questions that maybe you don't want to discuss in an open forum, we can share your details with Wayne, and you can pick up separate conversations with him after the session, or if your role's changed as of today, Wayne, maybe one of your colleagues. But I'm sure you can help in some way. I will
always help. Yeah, as I say, I still work here. I'm just doing a different role, so it's I'll gladly put you in touch with anybody who needs to do it. I'll tell you what, this is, as I say, forgive me, because I ran through all this earlier and had no problems whatsoever, and now it's just jumping about all over the place, and I can't seem to get it to stand still on any particular screen. So I'll tell you what I'll do. I'll do it this way rather than, this might not come through as quite as clearly, but hopefully it's just the background of it. So it seems easier for me to do it from here than on the on the presentation mode, because it's just jumping about all over. Can you see that? Does that make? Is it still clear?
Fine,
yeah.
So I'll go to this one first. So the mortgage process. So normally, some of this is UK Moneyman related, but it would apply to sort of any mortgage broker. Basically, you'd start with an initial appointment to go and see. I would obviously, I work for a mortgage broker, so clearly I'm going to say use a mortgage broker. But the reason I would say it is that if you go to your bank or your building society, they will be fine. They will help you, and certainly if you've got a good relationship and if you've got a good relationship with a high street bank or building society, you'll get a decent deal. A broker will advise you from all the lenders, so you're probably going to get a much wider range of choice, and whether that's us or any other broker for that matter. Whereas if you go to your bank or building society, you're only going to get their product. The broker would normally run sort of do a sort of a fact find, get all your details, what you do for a living, and do an affordability assessment, and get what's known as a decision in principle, or an agreement in principle, or an approval if it ends in IP, it's an in principle. There's all sorts of DIPs and AIPs and whatever, but they're all the same thing, which you could go online and you can do approvals in principle online. In my experience, most of these are not worth the paper that they're written on, or the whatever the digital equivalent of that is. Mainly because the thing would be, often they're not credit scored. They're not, it's just a quick affordability calculator. And sometimes, for example, if you tell the computer that you earn 30,000 a year, great. But if it turns out that you actually earn 15,000 a year as a basic salary and 15,000 a year as commission, then lenders would use it, would view it differently. So yeah, you earn 30,000, but that's not what they're going to take from a mortgage. And I think, therefore, if you're doing it this way, then you're going to get a more credible decision in principle that almost certainly will have been credit scored by a lender in the first instance. It's not a final decision. It's never going to be 100% guaranteed. There might be, they've not seen any documents at that point, for example. As brokers, we will always go to lenders that do what they call soft footprint credit searches at this stage. So there are still one or two of the old-fashioned lenders with old-fashioned systems where if you do a decision in principle, Virgin Money, for example, it automatically registers against your credit score. It's a hard footprint search. We wouldn't do that. We would relate it to the ones that have got a soft footprint search, so it's not doing you any damage. But they'll all do a full hard footprint search when it comes to the full application. When you've got your decision in principle, just view that as being your golden ticket to put offers in on a property. So you can go into an estate agent and you can say, I've seen, number 20 High Street, I'd like to put an offer in on that. And they will typically ask you for three things. They will typically ask you for proof that you've got the deposit, proof that you've been approved in principle, and proof of your ID. Because obviously they've got a responsibility to the seller, that they're not just taking offers from somebody who hasn't got a cat and else chance of actually being able to go through with the purchase. But your decision in principle should allow you to do that. Some of the estate agents, have we got anybody who works for an estate agent on the call?
Don't think we will, Wayne, so you probably shouldn't offend. I don't think so anyway.
Let's just say, I don't know if there was a panorama program. If any of you are actually thinking, I don't know if you can still get it on the iPlayer, but there was a panorama program recently called Undercover Estate Agent, and it highlighted a few slightly questionable practices, shall we say, over things like, using the estate agent's solicitor, or using the estate agent's mortgage advisor, making it out that you have to be pre-vetted by their mortgage advisor. You don't. If you've got a decision in principle already, you've proved that you can get a mortgage, and that's all they need to represent. So not all estate agents are the same. I've known some really good ones over the years. I'm not going to label them all, but just watch out for it, because they might make it out like something is the done thing when it's not. But you will obviously need that, one way or the other. You're going to need that sort of information for them to be able to accept an offer. They're also going to want to know which solicitor you intend to appoint. The legal work on this is known as conveyancing, because they convey the ownership from one property to another. And there are things like that have to be registered, for example, with the land registry. The solicitor needs to check that there aren't any other legal charges registered with the land registry that could impact on your ownership of the property. So there is legal work to be done. Again, you've got absolutely every right to choose your own solicitor. All I would do is get quotes, ring around a few. Most brokers, including ourselves, we can help you with it if you want us to, but it's not obligatory. Okay, so we can often point you in the right direction, but there's nothing to stop you using your own. And for example, if you've got family members who've used particular firms in the past and have had good service and recommend them, go with it. But you will need to know who you're going to use, because once your offer's been accepted, so you've made your offer to the estate agent and they've accepted that offer, we're then going to need to get all your documents off you. So it'll be typically things like your last 3 months bank statements, your last 3 months pay slips, proof of your ID. You'll always get a full document request. What I'd say to anybody who was planning ahead, start a little folder on your device, whatever it is. Put your pay slips into it. Every month that goes by, put that in, so that you've got, same with your bank statements. Scan your passport, stick that in your little folder, so that when you're ready and you've had an offer accepted on the property that you want to buy, you're all ready to go, and you can just ship that over to the whoever's acting for you to get the details, and it makes life a lot easier, a lot quicker. And they'll always give you, a list of what documents will be needed, but anything financial that you think might be appropriate, stick it in a folder, and then it's ready to go. The broker or the building society themselves will, they'll go through the full mortgage application with you. For ourselves, we'll have already got that information. Most brokers will get that information up front, and we submit the application for you. We'll keep you up to date with everything. What's happening when it hits the lender for the full application. They will do a hard footprint credit search, and they will instruct, and you'll see on that list I put valuation/survey. I always point this out because I always use the two words to mean different things. A lot of people will use them as synonyms, but not in mortgage world. The lender will do a valuation of the property. Now, the good news on that is most lenders will do that for free or for very little. Halifax charge £100. One or two of them still have a scale of fees for it, but majority of the big lenders do it for free. But it is just a valuation of the property for their purposes. And increasingly these days, they don't even send anybody to look at it. It could be what they call an automated valuation model or a desktop valuation. So where they're looking at Google Earth, they're looking at all the data on previously sold properties and things like that, and we'll make an assessment of, is it worth the money that you're buying it for? Now, when you're buying that property, you might want to know if its windows are going to fall out, if the damp proof course needs replacing, if the roof, is caving in. You might want to know quite a lot more about the fabric of that property than a basic valuation is ever going to give you, because the basic valuation isn't going to give you anything. And you might want to look at having a more detailed survey carried out of your own. Some of the lenders do allow you to sort of trade up sort of thing and do it through them. Most of them these days don't, and it's normally something that you do privately. You can get what's known as a home buyers report, or you can get what's known as a full building survey. The valuation, the class is level 1, home buyers report level 2, full building survey level 3, and obviously the cost of that can be quite expensive depending on the price of the property that you're buying. There's no rules on it, I think, other than common sense. If you're worried that you might end up having to spend more than you thought you would when you moved in, it might, or then get a more detailed survey carried out. Sorry, Dylan.
Yeah, it was just a question. I think it's not as bad as it used to be, but I think a good couple of years ago there was a real stage where a lot of people was offering more for the house than it was worth, wasn't there? I think there was such demand for houses that people were willing to pay more than the house was worth, but actually that only resulted in people being declined because the bank wasn't willing to lend that. Is that still something that happens, or was it just during that kind of, I guess, out of COVID and everyone looking really?
Yeah, well, we came out of COVID, and in order to get things started, the government suspended stamp duty for a period of time. And so obviously stamp duty, again, I'll mention in a second, but is a tax that is charged on property purchase. And so because there was not going to be this tax for a period of time, loads of people were sort of, let's buy now because we won't have to pay the stamp duty. Now, ironically, a lot of them, as Dylan's just said, were offering figures that would have cost them more than they would have cost them on stamp duty. And then the problem was that the lenders weren't agreeing with that valuation anyway, because they knew that it was like inflated value. What the estate agents were doing at that time was sort of saying, if it downvalues, we're not going to change the price. So you've got to prove to us that you can make up the difference if it does downvalue. And it all got a bit silly. Fortunately, that's not the case at the moment. Stamp duty is back in, and in fact the Labour government reduced the stamp duty limits, so actually you pay stamp duty at an earlier stage than you did then, and things are sort of back on an even keel. But it does highlight a point. It's that if you get an offer accepted on a property, legally at that point you're not obliged to buy it, and they're still not legally obliged to sell it. So if you get the valuation and the bank or the building society says, actually, you've put in an offer of 200,000, the bank or the building society don't think it's worth that, you can still go back to the estate agent and say, look, we've had our valuation, they've only valued it at 190, we want to amend our offer. Now, the seller could still say no, and in which case you've then got a decision to make. But until you exchange contracts, and that's the legal point where your solicitor is happy with everything and exchange contracts with the seller, it's only at that point that you're legally bound to buy. So if you do have your own survey, for example, and it highlights, even if the bank have said, yeah, it's worth 200,000, using that example, but you then find out that you're going to have to spend 10,000 putting a new damp proof course in, you can still go back and renegotiate. So it's not a done deal at the point of you getting offer accepted. Was there another hand did I see flash up, or is it gone?
Yeah, Emily's got a hand up as well.
All right, sorry, go for it, Emily.
Hello, sorry. No, I just wanted to ask, so in terms of like deposits and things like that, I've seen kind of a few things like I don't know if it used to be about where the government matched sort of what you would put in or something like that. I don't know if that's accurate or kind of schemes.
No. There used to be, it was on new build property only, and there used to be what was called a help to buy scheme, where the government would give you, basically it was a loan, but it was an interest-free loan up to 20% of the property. In London, it was up to 40% of the property because obviously the prices were a lot higher. Interest-free for the first 5 years, and then they would then start charging you interest on it. But that scheme was withdrawn, I can't remember now, 2 or 3 years ago. So it's there are still some other schemes, and I will touch on them, but that's not one of them. So there are some schemes where there's a little bit of help, but it's again, it's not as extensive as it used to be.
All right.
Just to pick up on these, this last couple of things. When the lender is happy that they've seen all your documents, they're happy with you, they're happy with your credit score, they're happy with the status in the sense that your pay slips prove what we told them, for example, and they're happy that the house is worth the money that you're paying for it, they then make a formal mortgage offer. It's a bit like a relay race, this. So up to that point, we're running the first leg for you, or your broker is running the first leg for you, or your bank or building society is doing that. When the offer's made, it's like the baton gets passed over to your solicitor, and your solicitor will start doing all the legal checks, as I say, land registry searches, local authority searches, to make sure they're not going to build a motorway through your back garden. Things like if you're in a mining area, they might need to search whether there's been any mining activity, things like that, to make sure that there's no legal reasons why you can't buy it. And when they're happy, they'll exchange contracts, and then completion, that's when your mortgage starts. So there's completion is when it starts. That doesn't sound right. It's completion of the purchase. So you complete the purchase, your debt starts. That's when the day that you start incurring interest from, and that's when you start making monthly payments. So in terms of, when you get an approval in principle, just to recap, you get an offer accepted, instruct the solicitor, get a survey, get the full application in, and get your mortgage offer issued, and then let the solicitor do their job. Few other relevant things which I've touched on already, but a couple to just do be sensible with your bank statements. I know it might sound silly, but if you've got it, for example, it's not a crime to have an overdraft, but lenders don't like it if you've exceeded your overdraft limit, because it's a way of them thinking, well, you can't live within your means. How are you going to afford the mortgage? I've mentioned gambling already, but it's things like that. In the run up to a mortgage, and certainly 3 or 4 months run up, just be quite conservative with your bank statements. They will typically need to see them. They'll need to see proof of your address. They'll need to see proof of your ID. So again, just make sure that you've got stuff on there. And this one, particularly these days, I would say, have a think about. We as advisors, because the FCA put a thing on us of avoiding foreseeable harm, we have to look at your budgets. We have to look at what is affordable, not just about can you afford it now, but are you likely to be able to afford it in the future? Few hands up again. So
yeah, sorry, one me, but I'll let Molly go first.
Yep, Molly. Hello, Molly. Are you there? Can't hear anything.
No, it's not coming through. My point was just on the bank statements, and I think it was more so just to check if it's real or a myth, Wayne. So you see on social media sometimes people might send a friend money, and as a reference they would maybe put something inappropriate. Is that a myth that would flag and cause issues, or is that actual reality?
A bit of both. I think it depends what it is.
Yeah.
For example, obviously banks and things are like hypersensitive about money laundering, financing terrorism, things like that. So if you put something on that could be, I won't give an example, but could be misinterpreted as something like that, then they're obliged to take it seriously. they're putting on your bank statement, for the supply of Kalashnikovs or something stupid like that, then they've got to take it seriously. I think, let's just say, I think I'd avoid it if you can. There are some, there is some that you look at and you just laugh, and I'm sure the bank or the building society would just laugh too. There are some that are quite rude and quite offensive, and I would try and avoid that if I can, but that's not you, obviously, it's your mates. So I'd just be a bit sensible. That is all I can say. It's not something that is a definite no. But there are certain reasons where they might have to take it seriously if somebody's been really stupid about what they've put.
Yeah, just be sensible. Momchil, you've got your hand up.
Just a quick one. Would there be any negative factors if on your bank statement every month, let's say, there's a decent amount of money coming out for investments? Would that be a bad look?
No. If anything, it'd be a positive thing, because obviously you're saving money. Again, most of these questions are always to be taken in context, Momchil. So for example, if you've been saving £500 a month, and you can prove where that money's gone because you're using it for your deposit, brilliant. You've already proved then to the lender that you can afford £500 a month, for example. Now, if you've got £500 a month going out and there's no evidence of where it's gone to, and it looks like you just either, again, I don't mean this to you personally, but if one is making regular payments, especially if they're large payments, but there's no evidence of any ongoing savings and no evidence of where that has gone to, then that might be some concern. But if you've got a standing order set up of however much a month to your your ISA account, and you're using your ISA account for the deposit, they won't have any problem with that at all. So again, I think you've got, all I can say is not just you, but anybody, it's all about the intent behind what you're doing and the proving of what you're doing. And if there's a proper explanation and a proper audit trail, it's going to be fine. If there isn't, and that money could be for anything, then they're going to have some concerns about it.
All right, cheers, mate. Thank you.
Okay, no worries. So in terms of sort of schemes, and again, I'm not going to go through all of these individually, but most lenders will do a mortgage if you can have at least a 5% deposit. But there are some lenders that will do 100% mortgages. Obviously, they're a lot harder to get. Not many lenders do them. And for example, I'll use Skipton as an example. They do one where if you are renting, they accept that it might be harder for you, especially with the level that rents are at these days, that it might be harder for you to save up for a deposit. As long as your mortgage is going to be less than the monthly payment that you're making on the rent, they would then look at lending you 100%. It's not, none of these are automatic. They will still look at your other income. They will still look at your other outgoings and everything like that, and your credit score. And clearly, if they're lending you 100%, then your credit score will need to be pretty good. But these are possibilities. I can't remember who it was earlier, so apologies, but mentioned about sort of government schemes. I'll pick a couple of things on there that are sort of, in fact, actually one of them I've not put on. Shared ownership is sort of a government scheme. Forces Help to Buy is a government scheme. So if you're in the armed forces, there is you can get sort of an interest-free loan based on your salary towards your deposit. You could argue that right to buy and right to acquire are government. They're not government financed, but they're government authorised in the sense that, if you're living in a council property or a housing association property, you can often use. They will often give you a discount. Now, the rules changed on this about a year ago, so the discounts that are available on right to buys now are a lot less than they were. But there are still discounts available that lenders will use. So if you do live in a council property, you might be able to buy it at discount, and they will use the discount as your deposit. The scheme that I meant to put on there, and I've not, is one called First Home Scheme. There is some, it's typically with new builders, where you can buy a property at a significant significant discount from its full value, typically like 30%. The issue with those is that it's only on specific properties on specific authorised sites, and you then have to sell it on to somebody on the First Home Scheme who would get it at 30% below the market value when you come to sell it. So there's nothing, there's nothing for nothing. Let's put it that way. That, it can be a handy thing. Shared ownership is where you don't own the whole property. Typically, these are run with housing associations, and you can buy, let's say, 25. Usually, it's 25, 50, or 75% share in the property, and you would pay a rent to the housing association for the proportion that you don't own. So obviously, the higher the proportion you own, the lower the rent that you'd pay. And it's a way that sometimes, particularly families, can buy a more suitable property for their family circumstances than they would be able to do if they were buying it outright and 100% ownership. What a lot of people think is that would help them with the affordability, because they don't have to borrow as much, so therefore their income would justify that lower borrowing. And usually that doesn't work, because for those people, by the time you take the rent into account that they've got to pay, they can't afford it. But it is ideal that if, for example, if your affordability says that you could afford a 2-bedroom terraced house, but because of your family circumstances you need a 3-bedroom semi-detached, you probably would be able to do it on a shared ownership. So that, it's horses for courses. Lenders buying off the landlord. Sometimes, if you've been a tenant for a long time, and your lender will sell it. Your landlord will sell it to you at a discount. Lenders will use that discount. And then on the right hand side there, you've got things like fixed rates, variable rates. Again, I won't go into a lot of detail, but there's, the typical one is a capital repayment mortgage. You borrow the money, you pay it back over the year, over a specified term of years. Most mortgages are on those. Often they will be at a fixed rate for an initial period of time, or they could be linked to the Bank of England base rate, hence the tracker. The last two, this is an increasingly an increasing part of the market. Retirement interest only mortgages, often called RIOs, and lifetime mortgages. Again, I don't know if we've got any sort of older students out there, or if you're all youngsters, it might be something that might be more relevant to your parents or your grandparents. But what you do find is that there's a lot of people who are on or around or reaching pension age that are going to see a significant drop in their income, because they're going to go from a really good salary down to maybe state pension only in some cases. And they're now looking at ways of, well, how do we make up the gap? And they're using the equity that they own in the property, their share of the value of the property, to fund things. So you take a mortgage out that releases some equity in the property. And those are particularly aimed at older people. A lot of people think, oh, I'm in my 60s, I can't get a mortgage. Well, you can. It just depends on what type, and obviously the way you pay those back is different to traditional mortgages. Again, I won't go into all the detail there. What sort of costs are you going to be looking at? So obviously we've mentioned the deposit. You might want to be paying surveyor's fees. You'll definitely be paying solicitor's fees. Surveyor fees depends on what you do. You might be looking at anything 600. It depends, and it also depends on the property. Ballpark figures, you're probably looking at something between £600 to £1,000. Solicitor's fees, again, it depends if you're just buying or if you're buying and selling. If you're a first-time buyer in this area, but I know that some of you will be dotted about, but you're probably looking at somewhere between £1,500 and £2,000, depending on the area that you're in and so on. The stamp duty is a big one. If you are a first-time buyer, you're exempt on purchases up to £300,000. So as first-time buyers, you wouldn't have a stamp duty bill to pay unless you were buying at more than £300,000. For onward purchases, if you're buying your second home or your next property, then obviously it would be bigger than that. these limits went down. So it used to be that the first-time buyer exemption was 425,000, but that went down last year to 300. And for normal stamp duty, for anybody else, it was 250,000. So if you bought a house worth 250,000, whether you were a first-time buyer or not, you didn't have to pay stamp duty, whereas now that limit is 125,000. So a lot more people are in that, are captured in that bracket of having to pay stamp duty. Always make sure you've got enough money for your mortgage repayments, but don't forget you're going to be paying council tax. You know, if you've been living with your parents or been renting, you won't have had to be paying money out for emergencies or your water pipes burst or anything like that, because you just get the landlord in, or your parents take care of it. You're going to have to fund those things. So don't just think about the mortgage payments, and you're going to be responsible for your gas and your electric and your council tax and so on and so forth. So just remember to build all those in to, you know, into your budget, really. I mentioned about the Financial Conduct Authority. By the way, are we okay for time? I'm conscious because I was late and everything, but
yeah,
are we
we've
all
got
right?
about 10 minutes left, Wayne. Yeah.
Right. Okay. Smashing. We're nearly there. So the avoidance of foreseeable harm. Don't just think about whether you can afford it now, but whether you might be able to afford it in the future if anything goes wrong. Now, none of these things on this slide are compulsory. And again, a lot of people say, oh, you have to have life insurance if you have a mortgage. And I would say, well, no, you don't. And for example, if you're a single person with no dependents and no concerns as to what happens to your, you know, your property after you're dead, why would you want life insurance? Because you're just paying that for somebody else. But you know, if you're in a family, or if you know, and you are concerned about leaving your in your family without a debt to have to clear, you might want to look at that. You might be in a job where you think, if I get made redundant, how am I going to pay the mortgage payment? So you might want to consider that. I have to be honest and say, I can't remember the last time I did any redundancy cover, because in my opinion, for most people, it's probably not worth it. But that you know, it's quite expensive, and for most people, they're back in a job before they get a chance to claim on the cover. But it's not to say that it might not be suitable for some. You know, things like, what if you got a serious illness that was going to lay you low for a long time? If you got cancer, if you had a heart attack, if you had a stroke, and you've still got a mortgage to pay, and not only are you worried about your health, but you're worried about, how am I going to keep the roof over my head? And there are insurances that cover that. Income protection, I've jumped family income benefit, I'll come to that, but income protection is another one. You might be working for people who have a brilliant sick pay scheme, and if you're off work sick, they pay you full pay for however long. Typical things like government agencies, NHS, things like that. You know, you might get 6 months full pay, you might get followed by 6 months half pay. Brilliant. But a lot of smaller employers don't have any sick pay scheme at all. And I'll use myself as this. We don't have a sick pay scheme. So if I can't work, I've still got my bills to pay. How am I going to pay it? And I'm talking about if I can't work through health reasons now, not through redundancy. Income protection would cover you for things like that. Family income benefit, again, you know, if you've got, for example, if you've got children and you weren't around anymore, you might want to make sure that they were going to be looked after, you know, until they reach maturity, and then you don't, you know, they can look after themselves. So there's all sorts of different things that can help you avoid this phrase that the Financial Conduct Authority uses, which is avoid foreseeable harm. You don't have to do any of them, you know, but you'd be daft not to at least consider them, because if you're taking a debt on and you're then in a position where you can't afford it, if you're a couple, if you're taking a debt on and you're basing it on two incomes, and then one of you's not got an income, you really do need to think about not just, can I pay the mortgage now, but what happens if something goes wrong? So that's what we mean by avoiding foreseeable harm. Last thing, and this was, and again, forgive me, I've forgotten who it was who asked the question, but if you want to make a note of that, there's a link to the Check My File screen, you know, for the credit reports on our website. So even if you don't make a note of that, link now, If you go to our website, you'll find it on there, or the company's just check my file. All I can say in terms of, preparing yourself, it's at the end of the day, mortgage lending is a risk business to the lenders. There's always the risk, no matter how good you are, there's always the risk that somebody might not be able to pay their mortgage in the future for reasons outside of their control. So there's always going to be a risk, but you can help mitigate that risk as much as possible. Keep an eye on what's happening with interest rates, try and get a bit of background information as to, there's a budget tomorrow, for example. Some of the things that I've put on there, for example, the stamp duty limit might change tomorrow. So just be broadly aware of it. Be prudent. If you're going to use credit, use it sensibly. And, by all means, so there's loads of online calculators where you can go online and put in a figure and it'll tell you how much your monthly payments were. So anybody can play around with those. I'd sort of say use those as a way of thinking, right, well, if that's what it's going to cost me on a mortgage, if I can start saving that every month, A, I'm proving that I can afford my mortgage, and B, I'm going to have a bigger deposit available. So if you are planning into the future, just a few little things like that will help. Is that okay?
Is that really good. Helpful? Thanks, Bryn. I'm just going to put the survey in the chat. If everyone mind just taking 2 minutes just to do that quickly before they log off. Molly did put her question in the chat. I've just seen it. So she just said, I don't think my mic's working. A question was, does having lots and lots of transactions coming out have an effect? So I'm assuming in relation to bank statements there.
Yeah. What I would say, Molly, is it can do, but again, it depends what it is. For example, if you use your debit card a lot, like I'm old school, I carry cash. don't judge me, but yeah, I'll have cash in my wallet. Whereas I know that, because I just feel a bit of a nana getting my card out to bit for, 75p packet of sweets or something. But I know that, a lot of you younger people just do it on your phone or whatever, and you might have lots and lots of transactions. That doesn't matter. What matters is if those lots and lots of transactions are taking you over your overdraft limit and you're not operating within your means. That's the key to it. Not how many there are, but are you operating within sensible limits? And if you're spending money willy-nilly and constantly going over your overdraft limit, then yeah, it would be important. But if it's just because you're doing £1, £2 purchases every day, then no, they won't be bothered about that at all.
Rob, thanks, Wayne.
It's all right.
And before we wrap up, has anyone got any other questions for Wayne whilst we've got him? Go on, Emily, hands up.
Sorry, I'm not sure if you can hear me. It's a bit of it might not make sense when I say it, but so you said about the stamp duty is at 300 and was it 300
for first time buyers, yeah.
So let's say you saw a house that was at that price, but you then put an offer in for just less than that, so you was under that bracket. Would you still have to pay the stamp duty?
No. So that's the threshold. So if you put in an offer at 299,999, you are below the threshold. As long as that is what is entered into the contract with the seller, and as long as that is the price that is registered with the land registry when all the things go through. I don't want to get too much into this because there have been sort of things where people have sort of said, well, I'll give you 299,000 for the house and 15,000 for your furniture, and it's trying to sort of wriggle around it. I'm not saying that that's not possible, but your lending would only ever be based on the price or the value, which is ever the lower. So look, I think there's always people that will try to come up with bright ideas as to how can we get around this. But personally, just in general terms, that's the limit. If it's below that, you're fine. If it's above that, you're not. You can still do it, but you're going to get a stamp duty bill. But the stamp duty is based on a percentage of everything above that. So, for example, if you arranged a mortgage of if you were arranged, confirmed a price of 301,000, you'd only get charged stamp duty on the 1,000, and typically it'd be 5% of the 1,000. So so it's not necessarily massive, but it does increase a lot. Obviously, the bigger the property, the bigger the percentages, and the thresholds go up as well. So if you were buying a really expensive one, it goes up. But best thing to do, if you Google stamp duty on the .gov website, uk.gov.org, I think it is, there's a whole thing about stamp duty on there, and it tells you what the thresholds are and everything.
Perfect, thank you.
Not at all.